There are a lot of reasons why markets go through correction. Look at this. Does this look like a rounding top? Now, there's actually a big bearish candle at the start of April, which doesn't happen very often. And right now, S&P 500 is testing some averages. Well, there can be a lot of reasons why stock markets go lower, but in any case, stock markets never go up in a straight line. Sometimes it just come down due to noise, such as a particular country defaulting, or a major company that is collapsing that could cause certain stress in the financial system. Or it could be like this time, which is the risk of war. Now, markets actually don't like uncertainty, but that actually does not mean that you cannot get used to uncertainty. Today, we'll discuss about this risk that's happening in Middle East, which is war. And I'll actually cover with you and give you some insights as to what exactly is going on. Not just that, I'll also be sharing with you 3 points regarding investments that you need to hear of. So if you're keen, continue watching. Hi guys, welcome back. Let's start with this whole topic of what's going on exactly with Israel, correct? You may have seen headlines that Israel has been recently bombarded by drones and missiles by Iran. But I'd like to give you some backstory to things. Let's recap again. 6th of October 2023, Israel got attacked by Hamas and they started a war on Gaza Strip. Many of their neighboring countries did not like that, and there could be some reasons due to religion. This war with Israel isn't too much of an impact to global markets because Israel doesn't quite impact the oil markets, correct? But who they are fighting against, directly or indirectly, which includes Iran, does impact the oil market. Iran supports the Hamas organization in Palestine. They also support the Hezbollah organization in Lebanon. They give them arms as well as give them funding. Then fast forward to 1st of April 2024, Israel allegedly bombed the Iran embassy in Syria. Now take note, reports have suggested that Israel was actually gunning for this top Iranian military general, Mohammad Reza Zahedi, and it's actually not the first time that Israel has gone after Iranian generals who work with the Hezbollah organization. I actually read through a lot of these informations to distill into sharing with you. So as always, smash the like button early for the hours of work put in to help you understand what exactly is going on. So this recent bombing on 1st of April 2024 was finally enough to make Iran retaliate. On Saturday night, 13 April 2024, Iran actually launched a massive drone and missile attack at Israel. Allegedly, they fired 300 plus of these objects. Take note, this is the first time that Iran has made a direct attack because previously they've been using and funding these groups to indirectly attack Israel, but this right now is an outright assault. That is why some articles mention that Middle East is on the brink of a major war and that this war could actually spill over very easily. As of this time of filming, Western media has in general suggested that this counter-attack by Iran is more of posturing because they didn't really fire off aggressively at Israel's capital, and it seems like they've given a lot of ample warning, which makes the entire defense a lot easier to orchestrate. Therefore, Western media has concluded that Iran actually does not want to go into a full war with Israel. Having mentioned that, war is often unpredictable. What we hear very often from media is noise or they have some biases. And when you're hearing this, things could have also changed yet again. So let's leave the war story aside and discuss next on what exactly will impact the financial markets and what you need to think through. In my opinion, this escalation, however severe, should lead to a market correction. That's actually pretty easy to guess, correct? And something I've been hinting on because again, markets don't like uncertainty. The harder question to answer is actually how deep would this correction be? Let's look at some history. S&P 500 response to geopolitical events. These 3 which I've highlighted seem very similar to what's going on in the Middle East. Saudi Aramco drone strike, S&P 500 corrected 4% and took 41 days to recover. Bombing of Syria, which is exactly what's going on now, caused only a 1.2% decline and it took only 18 days to recover. An Iranian general killed in an airstrike saw a decline of 0.7% and only 5 days to recover. all these various attacks caused small uncertainty only, and stock markets actually just saw a short-term decline. The recent Israel-Hamas conflict seems more severe, and that only caused a 4.4% decline in the markets. It's also arguable that if we were to see from 1st of April, markets have indeed corrected already, right? So there's no guarantee that it wouldn't bounce up also. Then the next question is, what if this war escalates? Let's look at some other examples. Iraq invaded Kuwait. That happened in 1990 as the Gulf War, and the total decline was 16.9%. Not the worst thing in the world. COVID crash was way worse, but investors probably got disheartened because it took 189 days for the markets to recover. What about the terrorist attack, September 11, 2001? That caused an 11.6% decline in markets, which this table suggests doesn't seem too much. But if you were to pull up the exact chart for S&P 500 back then in 2001, you would realize that markets continued to stay bearish. Maybe the overhang of the dot-com crash was still lingering, and this was just another bad news that market couldn't really stomach. In my opinion, this seems a bit closer to the Ukraine war with Russia in February 2022, which we've covered a lot on this channel. Back then, markets dropped because of inflation concerns, and the war only exacerbated the negative sentiment and drove inflation even higher. If you have been investing for the last few years, you kind of felt that bear market. But bear markets are like this. They come and they go. So that's why the first thing that I'd like to share with you is stay invested. Whether it's 18 days or 180 days, bad news will always pass. Markets dislike uncertainty, but markets have a short-term memory. Nobody knows whether this will be a small war or it will escalate, so no need to seek further expert opinion. What I would like to suggest for you to do is actually to check your cash balances. If you have very little cash on hand, then hang on tight. Don't average down blindly, because there's this saying that a 6-foot man can drown in a river that's only average of 5 feet deep. The reason is because to survive, it doesn't really matter the average. You need to survive at all periods and stay solvent. On the other hand, if you have money, maybe this decline is time for you to buy more. So consider this first point of staying invested. The second sharing that I would like to make is that oil investments probably look very good right now on the risk-reward point of view. This is not a debt crisis or a banking crisis. This is an oil crisis, plain and simple. So let's study back some oil history. If you were to look in terms of this ETF XLE, which owns the biggest oil players, the recent Israel-Hamas conflict saw prices of this actually shoot up and come down subsequently. But net there wasn't much decline. S&P 500 on the other hand declined 4.4% during this period. What about the Ukraine-Russia war? S&P 500 actually saw a bear market, but XLE ETF actually continued to make climbs. XLE ETF actually owns the biggest oil players like Exxon and Chevron, and it's just a simple ETF for you to get exposure to this sector. Not that this is any financial advice. My opinion is that the risk of oil sentiment is always on recession fears, and that is because of a demand drop by industries, correct? I think most will agree that recession is not likely to happen in 2024. So the risk-reward points towards a supply disruption. What if Israel retaliates beyond all imagination and this becomes a full-fledged war? Take note again, Iran is the number 7 player in the world for supply of oil. This is a supply drop that market cannot stomach easily, especially at a time when number 3 Russia's supply is not fully into the markets. The third thing I'd like to share with you is that long-term bonds, on the other hand, look quite bad to me from a risk-reward perspective. Again, this depends on your investment time frame. But as we know, bonds have came down yet again because latest readings on US inflation seems to be ticking upwards. At least for the last 2 months, it's been climbing, and that's why markets have been fearing that Fed might postpone rate cuts to the later part of this year. With oil prices potentially staying high or potentially even skyrocketing, my opinion is that this inflation rate is likely going to be stickier than expected, correct? And this has been showing up on the US 10-year Treasury yield. It's been climbing upwards yet again to 4.5%. This has also resulted in, for example, the long-term treasury bond ETF showing a decline in terms of price. Note again, yield and bond price is always an inversion, which means yield climbs higher, bond price would start to sell further down. That's why I would much rather go bottom fishing in Hang Seng, for example, or go bottom fishing in the REITs, where it's a segment that can still potentially grow well in a high interest environment. Let me know if you agree with these sharing points or not, and as always, smash the subscribe button if you haven't done so, and I'll see you in this previous video, mistakes to avoid on the financial markets. Check that out, maybe it can help you in your investment journey too, and I'll see you there. Take care as always, goodbye.